Hello, my name is Donna Hughley, and today we're going to be talking about how to read those darn financial statements. What we will cover today is a very high-level Accounting 101 discussion. We will then talk about the balance sheet versus the income statement, the differences. We'll have a brief discussion about cash versus accrual accounting, and then we will spend most of our time on how to read financial statements and things to look for. On a day-to-day basis, your association has lots of transactions going on. It can be billings to homeowners, it can be collection of those dues, payments to vendors, making journal entries to record various activities. All of these different transactions get coded to an account in the chart of accounts. If you think of each one of these accounts as a bucket, each bucket will accumulate the ins and outs of that particular account on a monthly basis. Those buckets ultimately lead to a balance sheet and an income statement. The balance sheet is a snapshot of the association's financial position at any point in time. It includes the assets, what the association owns, liabilities, what the association owes, and equity or retained earnings, which is the value of the association to the owners. The income statement represents the revenue and expenses for a set period of time. The revenue is the income that the association has earned, and the expenses are what the association has incurred. There are two prevalent methods of accounting, cash versus accrual, that board members often ask about. Cash basis is basically cash in and cash out. Think of this as what happens in your personal checkbook. You record deposits and you record checks. The problem with cash basis of accounting is it does not give you a good overall picture of how the association is doing. The more prevalent and more correct method of accounting is the accrual basis. And in fact, this is required by GAAP, or generally accepted accounting principles. The accrual basis of accounting is required by generally accepted accounting principles. And this is the method that CMA uses to produce your monthly financial statements. It includes accounts payable and accounts receivable. It matches revenue with the corresponding expenses, and it just gives a better overall financial picture of how your association is operating on a monthly basis. We will spend the rest of our time discussing how to read financial statements. These ideas do not apply just to your homeowners association. They can apply to your company or anytime you are looking at a set of financial statements for a potential investment, your personal accounts, or whatever. The first item on the balance sheet is generally cash. As we joke, you don't like to see brackets around your bank accounts because that means the account is overdrawn. You want to watch cash balances and make sure that they are trending as you anticipate. So for example, at the beginning of the year, you're going to be getting in a lot of money from your homeowners for dues, and therefore your cash balance should be going up significantly. If the association is setting aside funds for future major repairs and replacements, then you want to watch your reserve cash, and that balance should be going up. If you happen to have a major expenditure for a particular reserve expenditure that month, then the cash balance would understandably be decreasing. Some associations have a requirement for restricted cash. This is generally a requirement by the town or city that the association is located in. So for example, if your city requires that you set aside money for street repairs, then you want to watch this cash balance to be sure that the required funding is being made on a monthly or quarterly basis, and that the only expenditures coming out of the account are for that particular restricted fund. CMA will provide you with the monthly bank reconciliations and bank statements. You should always look at these for any items that look unusual or don't make sense to you, and then ask the CMA manager or accountant about them. Moving down the balance sheet, you will next see accounts receivable. You want to watch these and make sure that increases and decreases follow expected trends, including the time of the year. As we just discussed, you may have annual billings, and you would expect that your accounts receivable will be very, very high in January, but they should start coming down in February and March as all of those bills are collected. If you don't see a significant decline in the receivable balance, then you should question why. If the association has quarterly billings, then you'll see spikes in January, April, July, and October when the quarterly assessments are done, and then in the following 2 months, the receivable balances should come down significantly. CMA provides an accounts receivable aging, and you should review that. As accounts become delinquent, certain collection procedures will automatically come into play, but you want to watch that your delinquent receivables are not getting too old or too large, and these should be discussed at board meetings or other appropriate venues. Your association may or may not have an allowance for doubtful accounts. The allowance for doubtful accounts is a best guesstimate by the association of potential uncollectible accounts, i.e. bad debts. The allowance can be adjusted upward or downward as needed during the year. But as you review the financial statements, you want to watch the allowance and make sure that it is not growing too much. Otherwise, this is an indication of collection issues that need to be addressed. The next item on the balance sheet is furniture and equipment. Generally, a homeowners association will not have much in the way of fixed assets, as they must be sellable and separable to be reported on a homeowners association's balance sheet. So you want to question increases to these accounts to be sure that they truly should be set up as an asset. The association may have other accounts receivable, and you want to look at these to make sure they make sense and to be sure that they are paid timely. The last item on the balance sheet that we will talk about is prepaid expenses. These are expenditures that the association has made ahead of when they will actually incur the expense. The most prevalent example is prepaid insurance. The association may pay for an entire year's worth of insurance premium, and so they will put this amount on the balance sheet and amortize or write it off over the 12-month period. So you want to look at the prepaid expenses and make sure that the trends are making sense. So if the insurance policy is renewed in July, then you would expect to see a large increase in July, and then that amount would come down over the next 12 months. Moving to the liability section of the balance sheet, the first item you will see are accounts payable and accrued expenses. These are monies owed to vendors. As a general rule, these will be relatively constant or should be decreasing. If you see these increasing significantly, you need to ask why. It could be an indication that the association does not have funds to pay their vendors. The next item will be prepaid assessments, and these again are where homeowners pay their dues ahead of time. So these amounts should generally be decreasing except when you get around billing time. So for example, if you do annual billing, your prepaid assessments will probably shoot way up in December because people pay their dues before the actual due date of January 1st. The last section of the balance sheet is the equity section. This is the equivalent of retained earnings if you're used to looking at company financial statements. The trends here you want to watch are very dependent on your association. If your association is in a growing phase, then retained earnings should also be increasing. You also want to watch the reserve section of the retained earnings section. If the association is setting aside funds for future major repairs and replacements and has not incurred any significant expenditures in this area, then you should see this section growing as the association funds it. The next financial statement that we're going to talk about is the income statement. The income statement records the revenue and expenses of the association. Look at the dues revenue. It should be fairly consistent from month to month if you are an established association. If the association is growing and or adding new phases, then the revenue should be increasing on a month-to-month basis as you add new homeowners. Look at other income for its trends as well. If the late fee income is increasing significantly, that could be an indication of collection issues. On the expense portion of the income statement, you want to look at trends there as well. And finally, we are going to discuss expenses and how to review those. You want to watch trends in the balances. Do the month-to-month changes make sense depending on that particular account? As an example, you would expect to see your water expense spike in June, July, August, and September. If you had a significant jump in water expense in February, that could be indication of a major leak or something that needs to be addressed. CMA provides a monthly budget variance for you, and you want to look at those variances and ask why. I know your manager will provide commentary anyway, but look at significant differences between the actual amount and the budget amount. It could be a timing difference, it could be an unexpected expenditure, it could be a blown budget, it could be a number of things, but you want to understand why those variances are happening. You also want to look at current month versus year-to-date balances and make sure they make sense. For example, you would expect that your management fees each month to be the same amount. So the January amount is going to be 1/12 of the annual amount. Other expenses such as water are going to fluctuate depending on the time of the year, so you wouldn't expect those to be as consistent. Finally, you want to look at unused budget amounts and understand why they are unused. If your dues revenue is significantly under budget, it could be that a new phase that had been anticipated hasn't actually happened yet. If a landscape line item is under budget, it could be that that particular landscape project got deferred until a future month. Thank you very much for viewing How to Read Those Darn Financial Statements.